Hi, welcome to the Market Alert for Thursday, the 12th of September 2019. So, stock surge on biggest short squeeze. We'll go into this in more just a moment. In 8 years, despite momentum meltdown. And also, whilst we're here, take note of this. This is today. Last minute hurdle emerges in ECB's attempt to shock and awe markets. It could be a bit of a problem with what Draghi is proposing, another 30 billion per month bond buying program, reducing rates. And as I've said to a lot of friends of mine, you can forget the politics of Europe. It's imploding by itself because of the way it's actually set up financially, with a blanket interest rate, inflation rate, and the banks in a shocking state of affairs. Which is ironic, really, because when they were all independent countries, this didn't happen. Amazing, really. But yeah, irrespective of what happens politically, financially, it's a basket case, as can be seen if you just read the detail. Do the studying, you will see for yourself. So, will Draghi manage to pull off his 30 billion a month today, or reduce interest rates? His sort of last stand before he clears off and allows the criminal that is Christine Lagarde, a convicted criminal as well, to take over from the IMF to the ECB. You couldn't make this stuff up. You really can't. Anyway, let's have a look, see what's happening with this short squeeze. Like I've maintained and will continue to do so for the foreseeable future, there's no way they're going to let this market go down. It's all on the buy side, using the 200 bar moving averages combined with the implied volatility, and we see that we're heading it towards 27,401 before long. So yeah, interesting to see this happen. No doubt this could happen today if Draghi announces 30 billion bond buying program today as well. It'll be straight through this, already up in anticipation. So what is a short squeeze? Well, a short squeeze is quite simple. A lot of people decided to go short on the stock market, and as prices are brought back by the plunge protection team, the Federal Reserve, the traders, the banks marking prices up, no volume, they just mark it up, then these people are squeezed out of their positions. They can't take the pain on the short side, and therefore they have to buy back the position, and this sends the market to the upside. Now, again, if we look at yesterday's price action, we come down to the 200 bar moving average. And what do we get? As ever, we get that same pattern. It's that predictable 76% retracement sitting on the 200 bar moving average, and prices just continue to move higher throughout the whole of the session. The only time they come back and have a look at the 200 bar moving the 20 bar moving average is here, and then it's up all of the way. So you don't need to wait for automatic signals. Learn to see the patterns in the market, and then you can use this in order to take your trades and position yourself with the minimum of risk and a higher reward as well. It's amazing what you can see when you actually start to look for repeatable patterns. So the only news today is Super Mario, and that will be at 12:45, 7:45 I think, New York, for those on the other side of the pond. And meanwhile, in the pound, yesterday a bit of a choppy session with the to and fro-in and what's going on with Brexit, and whether it's now legal or the prorogation is legal or not. Anyway, the pound moved low after it broke the 200 bar moving average. That's all I need to see. It tried in vain to hold, and then eventually it came through, and the market moved lower. And overnight prices sideways there to higher. I'm just going to go back to the Dow actually, because I didn't actually look at what's occurring overnight. And here you can see, again, we blast to the upside on the futures market, and so far the market waiting for Super Mario at 12:45. Bitcoin a bit sideways at the moment. Well, sideways to lower, heading down towards the 76% retracement that we can see here. Below all averages at the moment. Sorry, the two averages, not all, because the 200 bar is fully intact still, which you'll see just below that. And the 4-hour price is having banged its head against the 200 bar. Tried to close through here with 3 attempts, and then now it's showing its weakness, but it is trying to come back towards it. The play here is very simple. What you do is you get the retracement tool. We can see the market's starting to move back up. The key here is this, to trade from this low to this high at the moment, and if prices find support at 99.36, there's every likelihood then that they will come back and have another go at the 200 bar moving average and offer either a short or break through. So that's how I will play this, because there seems to be this pattern where the market will trade away from the 200 bar, then it will come back, and as it moves away, you see there it moved away, it came back, moved away, moved back, moved away, and this time it's moved further away, but now there's a possibility that we could see some support at that 76% and then move back. And then of course it's crucial what happens when prices trade back, but you start to see the pattern of how this actually happens. It always comes back, it always goes away, and then to determine the turning point you can use the fib retracements, as we do quite well in the Dow with the repeatable pattern. We can see that pattern as seen earlier. You see it there, comes back and then off we go, and that's obviously having closed above, but it works the other way. There are only so many options that can occur there. And yeah, back to Bitcoin. Sorry, I'm getting carried away here. And in the 15-minute chart, you can see the buying coming in yesterday, yeah, blatant, and it's fantastic. This is how it used to be with trading volume until they started manipulating in 2008. The market moves higher, and then again you can see the buying coming in again once more to support the market. And there you see prices trading up to the 200 bar moving average. And if we do this from here to here, you see the market stopping at 76%. This is what I'm on about. So you go up, you come back, and then you head back towards the 200 bar moving average there. And then if it fails, you start moving back once more. So again, that's sort of repeatable pattern that you can see there in the market. And the rest of the news, implied volatility has fallen out of bed, no surprise. You've got a short squeeze on, no risk to the upside, even though the momentum trade is falling apart at the seams and the quants are in meltdown. They are moving the market to the upside, so down to 1171 from 1332 yesterday. And you can see this here, you've got green all the way, which means that there's no risk at the moment to the upside. That said, when there's no risk, there is a very good chance of risk coming into the market. That's the sort of paradox of implied volatility. Once you get your head around it, low implied volatility, even though on the face of it looks like low risk, it creates a vacuum, and the vacuum will eventually be filled, as we've seen many times over the years. Meanwhile, the yield curve is narrowing. We've had the peak by the looks of things at minus 0.52, and now heading back up. And of course, once we return back to green and the yield curve returns to normal, it's just a matter of time then, because the catalyst has been made where we then head into recession. Let me just give you the bigger picture view. So here you can see all of the previous occasions where it was red, then it reverts back to normal. You can see the normal there, and then it's followed by recession, which you can see there as well. So we're heading back towards the green at this point, unless something else happens, but that's the way it's panning out at the moment. Again, look for the patterns, and you can predict and forecast when you look for the repeatable patterns. Okay, that will do it for this one. If there is anything else to report, I will let you know. Keep an eye on Draghi at lunchtime. Will be fascinating to see. And it's his last swan song. Thanks for watching. See you in the next